Welcome to Scottish University, Module 3, Lesson 4. This lesson is on chart patterns as part of the price action series. What we're going to look at is not an exhaustive list of all chart patterns, and this is not a basic technical analysis course. What I'm going to do is show you that the patterns that I use and how I trade them, how I use them in confluence with other factors, and what I like to look out for in terms of being able to scalp profitably. First thing to say is there is no pattern that is inherently predictive of where the market is going to go. Best example of that is the typical retail mindset. Okay, so if you read a trading book, a technical analysis book, it will teach you all these patterns. Bull flag, pennants, bear flags, head and shoulders, all these different types of candlestick patterns that essentially are supposed to mean something about what direction the market will move. I'm here to tell you that none of that is by itself useful, right? So the common thing that happens is you'll see one of these YouTube videos or whatever on Twitter, you'll see some guy who charts after time, of course, after it's happened, a big pump or a big dump and saying, look, it was the bear flag, it was the bull flag, it was the head and shoulders, whatever. It doesn't matter if it works once. Of course it can work. Of course a bull flag can lead to a pump. But how can you trade that to be profitable? Are you just going to long every bull flag? No, obviously not. So what we'll look at here, for example, this will give you an idea. So from going through the rest of my course that you've been in up to now, you'll know that psychology is extremely important. Market psychology and sentiment are the biggest drivers of price action and of where price actually moves. Typically, as a trader, you want to be contrarian. If you are going with the crowd, you are not going to be profitable in the long term. So if everybody's screaming up and you also jump in and go long, you might win. If you catch a bull market and everything's going up just for an extended period, yeah, you might briefly be able to win. But typically, the market moves in the way that is going to cause pain and lost money and liquidations to the greatest number of people. This is why you have the smart money and dumb money kind of labels. Smart money is inherently a smaller number of people. The number gets thrown around a lot. 90% of traders lose. Let's say that's true. Obviously, nobody knows the exact number. Let's say 90% of traders do lose. That means 10% of traders are what we call smart money because they manage to make money in the markets. That means that the 90% are doing things that are detrimental to their profitability. One of those things is being lazy and thinking that a simple pattern can infer a direction for a market. You want to not follow the crowd, so all you have to do is go to YouTube, search chart patterns, and look at this. Look how many views there are on videos about understanding chart patterns for trading. Technical analysis is hard until you see this. Look at the clickbait shit. Ultimate chart patterns trading course. Expert instantly. And look what it's telling you about. All these mystical patterns that are designed to just make everybody a millionaire. Obviously, you've made it this far in Scottish University. You are already smarter than the average trader. So I know you're looking at this and laughing. Now, before we get into it, it's not smart to immediately discount any value that these patterns may have, because that can lead you to becoming myopic. Meaning, if you just think, bull flags always break down instead of up, or an ascending triangle doesn't break upwards, it breaks down more than often, whatever. It can lead you to be giving gaps in your analysis. You won't take a head and shoulders into account, when in fact a head and shoulders is actually a fairly useful pattern, which you'll see me talk about in the next few minutes. But obviously, look at this. I don't know if I haven't done it, but if you go to YouTube and you search for a bit of a more reliable concept about contrarian trading or trading against the trend, or some more advanced concepts like open interest, cumulative volume delta, order flow, you're probably not going to see 2 million, 1 million, 1.9 million views. So if you go to YouTube, I've loaded up a private window, so there's no search history on this. I'm not signed in, so there'll be no bias to what the results are given. But you saw on the screenshot, chart pattern things are getting millions of views. Something I think is infinitely more valuable than a chart pattern is funding rate. That's it. Funding rates explain. 14,000 views, 4,000, 33,000, 19,000, 8,000, 800. CVD explain in trading. CVD divergence 22,000. Cumulative volume delta explain 17,000, 17,000, 8,000. Open interest in crypto 23, 32, 47, 46, 7.9. All right, and just to reinforce it, let's do the chart patterns again. 2 million, 3 million, 13 million, 1.9 million, 1 million. I think that makes my point pretty well. We have established that by themselves, obviously chart patterns are not useful. All right, so you can see chart patterns, if you're going by the YouTube algorithm, the YouTube searching, it's way too retail dominated, it's way too mainstream, and it's not going to be something that's going to offer you much alpha, much edge in the market. Let's look at one chart pattern that I do like and I do put a lot of stock in, which is the over-under and conversely the under-over. Very simple. They are a reversal pattern. How do they work? Well, this is the chart. You make a high, you make a low, you make a higher high, you then break down beneath the low which led to the highest high. This is known as a market structure break, which obviously in lesson 1 I talked all about market structure, so I don't need to go over that again. You should know by now what market structure is. Same on the bottom. If you come down, you make a low, you make a high, you make a lower low, you then break back above the high which led to the lowest low, and you retest. And typically, a lot of times you can reverse. The higher time frame this occurs on, the more reliable the signal. This happens on a 1 minute chart. Don't expect it to work every time. To illustrate that, we can go to a 1 minute chart right now. We can look back. Remember, on this chart, blue is up, white is down. I don't use red and green candles. If we look at this, let's look at some under-overs. All right, under-overs for a potential reversal. Where could we have seen one? Here, let's just imagine this was the high, which led to the lowest low. Break back above it, and it held. So even on a 1 minute chart here, this was the high that led to this lowest low, yeah? You can see it. Then we break above it, here and here. We then retest, and it does form a reversal on a low time frame. Let's move it on and show you the opposite, an over-under pattern. We're strictly going off the candles. When did market structure break convincingly? Yeah, here's a good example. Here's a low, which led to a new high. So this low led to this high, which broke above this high as well. It actually broke above pretty high time frame level. So we had low, we had high. We broke below that and closed. So that would say what? That trigger would signal a short here. Once you bounce back above for a retest, the trigger would be to short this. Gets blown out. Because a 1 minute candle by itself is going to have so many different variables that it's not super reliable. If you imagine a 1 hour candle looks like this. Within that, you have 60 1 minute candles doing this. It'll go up to the top to create that wick. It'll go down, it'll go up, it'll go down, it'll go up, it'll go down, it'll create that bottom wick, and eventually it'll close. That's what the 1 minute can look like within one 60-minute candle. Just a visualization of why higher time frame is more important and why you shouldn't put too much stock into these patterns on a super low time frame. They are useful, of course, but they're not the be-all and end-all. So let's dig in a bit more to the proper use of them. If you're a scalper, you always want to start with your daily frame. All right, so daily, let's take an example here. Here's a key high that is set. We then run it. So we know we've gone through this high. You're looking for a potential reversal. So as a scalper, how do you want to trade it? You want to trade it so that whenever we trade back below this level, because what you're looking for as a trader and a scalper is to catch quick moves in the market. What happens when it goes above this high and then it comes back below? It's potentially a deviation because price moves between areas of liquidity. It's going to move from here to here to here, and then it consolidates for periods, so not breaking the low, not breaking the high. When it then breaks that, that is a perfect opportunity for smart traders who bought in here to offload, meaning they sell their bags above here because there's guaranteed liquidity. Above highs, there's guaranteed liquidity in the form of buy stop losses for shorts and also breakout traders who go long. That's all buying activity, which the guy who bought here can use to sell, and he can bank roughly 30% profit. That's the mechanics of why price moves. As a scalper, you allow the breakout to happen. You don't have to trade it yet. Then we get this break back down. We close a couple of dailies back below this line. You're like, okay, this is potentially a deviation. So then what are you looking for? Well, you say, okay, over the next few days, I'm looking for shorts. So on the 2nd of April, we're going to then zoom in to your time frame that I would recommend you kind of frame your trading from after the daily. So daily gives you your overall bias in this area. You then want to go into a 60-minute. And go to the 2nd of April. So a 1 hour candle, 2nd of April. Now you want to look for structure breaks on the 1 hour. So remember, after this happened, you're not going to short this breakdown. But what you're going to do is you're going to say that signaled on the daily that this entire structure might be distributing and it might be a sell-off to come. So on the 1 hour chart, when we get a bounce, you're not going to short a breakdown. But when we get a bounce back up here to retest, because typically it'll retest, I am looking for market structure breaks on the 1 hour chart that I can short. You look at that. You start drawing your market structure and looking for over-unders. At the beginning, you're looking at this uptrend. So each of these highs, as it makes them, you're looking for how does price react when it goes above those highs, right? And it runs the highs. But always remembering on the way up, for example, when it sets this high and it runs through it, I wouldn't be expecting to short that right away because there's a lot of room for it to move up into this area and maybe target these highs or target a high that gets created in the meantime. When you're just starting an uptrend, don't put too much stock on what the highs mean. Here, this one was quite a significant high. We pushed up, we set it, we consolidated, we broke above it. So here's your market structure level. There's a low, it breaks up above here, comes back down. Eventually here, the market structure does break. All right, so at this low here, this market structure level, which I'm going to mark as a dashed line, it breaks. You can say, okay, when we come back above this line, I'm going to look for a short on another retest of the same level. What you could have done was when it bounced back above here, you look for the same pattern again if you want to get double confirmation. So you're waiting to see, does price violate market structure again? So on the 60-minute, you begin to draw your levels again. So we're now back above this line, we're retesting. We want to find another over-under. We start marking our highs again. As they develop, maybe the highs here, but you'll notice that we don't break any market structure. Market structure level was here, we didn't break it. It was here, we didn't break it. It was here, we didn't break it, until we had a big run above and then it broke. Do you see what's developing here now? The initial move, this high getting broken by this low. This low led to this high breaking. Price went like this and came back below. We bounced back above it. But if you're waiting for your double confirmation, it doesn't come yet. So you shouldn't be shorting this. There's no reason to short yet. There's no reason to short yet. And by not shorting, you saved yourself from getting stopped out on a potential trade. Because we did get a push then we got a break. All right, so that you can see it. We're now on to our second over-under. The first one was there. Second one is here. And these are hourly candles. So this isn't going to miss you. This happens much slower than you think. You just need to be conscious of it in real time. That we had this low led to this high, which swept out all this liquidity. It then sold off, closed back below this level, and traded down beneath it for a while. There's your signal. And now, can you see what's forming? This is your true over-under. Obviously easy in hindsight to see it. You can see quite clearly that it wasn't the first high that was the true high. And you have to kind of be conscious of this as well. Remember what the pattern looks like. The pattern is head and shoulders. For that, there has to be a shoulder, a head, a shoulder. So when you see price moving up, and it's spiking up, you see something like this, you think, even just look at this, even just look at the shape of this. You're like, okay, is that going to be the head? Well, it looks more like a shoulder, doesn't it? Because there hasn't been a second move. You could say, I thought this was the head and this was the shoulder, but that shoulder wasn't valid because the market structure didn't break till here. So look at this and use a bit of discernment and say, this might be the top, but this is probably more likely to be the left shoulder of the head and shoulders or the left side of the over-under. And then, of course, we get this run and then a sell-off. Pretty clear signal from the market. You're like, okay, when price is down here, you can then look back and say, okay, over the past few days, this is 2 or 3 days, we've had a potential shoulder, now the head. Where should it go? Well, there was the market structure. You don't want to short beneath that. So when it's broken down convincingly, wait for the bounce because it almost always does bounce. And above this level, you then want to start filling your shorts. All right, you can scale in, you can put all at once, put your stop above there, whatever you want to do. But look, you've 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 15 hours before that break. You've plenty of time to get yourself an entry, and it turns out to be pretty much a perfect over-under because the second shoulder comes up almost exactly to the first. If you look at the perfect setup, it's this, it's the shoulder, the head, the break of structure, and then a perfect tap of the same level. That is pretty much what you get there. So at this point, when it's up here, you can start filling shorts, but you also want to be on the lookout for a final sweep of the liquidity. So this is where you can go into a lower time frame again. So we're looking at the 5th of April. All right, so we go to the 15 minute. We go to the 5th of April. We're looking to get, and remember, time matters. We are trying to scalp. So even though we're on the 1 hour chart and we're looking to short, we're not looking to sit in a trade for too long. So yes, as soon as it breaks back above here for the retest, you can enter part of your short. But also just look back at previous, how these things form. They take time. It typically consolidates, chops around because that makes people uncertain and makes people make bad decisions. If you short it there, then fine, yeah. You short it there, with your stop above here, eventually you're right. But you have to sit in a trade for 4th of April, the 5th of April. You have to sit in a trade for over a day before it really breaks. Instead, let it develop. So it breaks above and it begins to consolidate. It sets a high here, it sets a low here. So there's your consolidation. Price breaks up, it starts to go sideways. People don't know, is this accumulating, is it distributing? They don't know. What you're looking at, since you already know that structurally it's looking bearish, the price action is telling you that it's most likely bearish because this breakdown was your signal. Odds are, probabilities are, is that this is something you want to short. So how would you do that? Well, you've allowed this to form because you allowed this high to form and this low to form, and then it's chopping inside. You can say, okay, well, I'm going to add to my short every time it goes up to this level, near this level. So you could short there, you could short a bit more there, and then always have an order set above the high, because what will typically happen before we finally sell off is we will sweep a high. It can be an intermediate high. All that matters is that it's a high because there's going to be buy stops there. There's going to be people who went short here, put their stop too tight, and they're going to get taken out because those type of people don't get good trades like that because they basically FOMO'd in. They rushed into the trade. They're trying to kind of force the market. So you can just leave your orders, some orders above here. Price breaks up, your orders get filled, sells off, and obviously you get a nice deep sell-off. So that's the essence of how I trade an over-under. It's the exact same for an under-over, just in reverse. And the way you want to look at it is, if your daily is showing signs like we just showed, you went to the daily, always start with the daily. If your daily is showing signs of distribution, like it was, it ran above a key high, dropped back below, and then you go to your hourly and you're seeing a pattern form, you then go to your 15-minute to execute, or if you want to go to your 5-minute to get an even tighter entry and execute, up to you, it's personal preference. And so ideally, you filled part of it here at 5:45 on the 5th, and then the rest at 1:15 on the 5th. So all in the same morning, and then the move happened. Instead of, you could have went short anywhere in here. Well, you wouldn't really have known because, of course, this ended up being the high. But after this clear break, you could have went short anywhere from here all the way to here with your stop above there and still been right. But think about it. You're not perfect. Nobody is immune to their emotions. If you went short here, you ended up being right, but look, you had to go through all this squeeze. And this right up to here, you're like, oh, maybe I should cut it. And you get squeezed out, and then it drops. Patience, allow it to form, understand the structure is broken, and you just need to allow the market to do what the market does. So then when you're looking at this from a pattern perspective and trading it, what do you want to see in terms of targets? Well, the common way of trading head and shoulders pattern is to target the neckline. For example, if you have a move like this, so you want to short and target a break of the neckline, which is like from this side to this side, like that. If you go short, you want to target a breakdown here, or an equal move in line with this, same amount again. There's many different ways that people trade in terms of targets for them. I don't trade that way at all, so that's why I kind of rushed through it. I think that's it's a very first level of thinking. It's not very, basically, I think it's a dumb way to trade, is to just think if head and shoulders pattern happens, it has to extend exactly, as far again from the neckline as it did on the way up, whatever. No, I wouldn't do any of that, because price doesn't move based upon mystical patterns. Price moves to areas of liquidity. Where is the area of liquidity you should target? It is a key low. Look at this. We had this big breakdown, which is the first sign we had that we might have a potential short coming up. So the big breakdown to here, set a low, and then we bounced up. Well, this is your target. Very simple. Forget about your distances and necklines and all that shit. That's your target. Because on the daily, this yellow line, remember, is the breakout. So the daily, it broke out. It then lost that level and sold off and broke structure as well on lower time frames. Not the daily, but it broke structure on the 4-hour, 6, 12, broke structure on all of them. This low was set. We bounce up. We then go into a distribution pattern, which we've talked about. Shoulder, head, shoulder, over, under, whatever you want to call it. So if it is distributing, which eventually it does, you get filled somewhere around here, it starts to break down. Where are you going to target? It's obviously going to target this low, because that is where the next area of liquidity is, in the form of sell stops. Traders put their sell stops there because they went long. Someone went long here, targeting new highs. They put their stop below there. So let's imagine you went long here, you put your stop below there, you targeted these new highs, price bounced up to it, didn't quite reach it, reverses, where's it going to head for? Going to head for your stop loss. Then you're looking at risk to reward. If you get short in this area, let's say you even just get a decent entry but not perfect, you get short in the middle of this consolidation, right bang there, you put your stop above the high and you target the green. There's a 3-to-1 risk to reward. That is a good trade. That's a valid trade. That's a trade you can take. By entering at the right time as a scalper, you get in here in this area. So let's say the first fill was here, giving an example. 5:15 on the 5th of April. The first entry was there. You get out of that trade when it hits here, which is a day and 9 hours later. That's not too bad. That's a pretty good trade. I would take that, especially for a 3 hour. If you want to do scalping micro movements, you can, but obviously your moves are going to be much smaller and they're not going to be as reliable. Some people would have taken just this trade, where it's this intermediate low here, and this is a valid way to trade as well, would be to take this intermediate low, because people will have long that. Any of these obvious lows, there are absolutely sell stops below them, which is liquidity for you to take profit. That's the way you should be viewing it. If you're targeting that low, and you're in this consolidation, you're saying, okay, we're in the process of putting in the right shoulder. I'm going to short a sweep of this high, because you have to get your risk reward on point. So you could say, I'm going to short the sweep. So you're going to put one order just above these two highs. Because look, when you get these equal highs as well, very, very likely that they're going to get swept before we sell off. You put it above the equal highs. So you put it there. Same area for your stop loss. But your target is down here. This actually gives you a 3 hour trade as well. So you notice you can make the same risk to reward trade. And if you get entered on that sweep, you get entered here and you trade it down till it breaks here. That's done in 11 hours. So less than half the time that you need to be in the trade. So that's the best use for an over-under. Again, same thing applies, just invert the chart. Same thing applies on the downside. Look for it to form, break, and it'll reverse it away. It's not 100% accurate, but it is certainly accurate enough that you can make money doing it with good risk reward. Let's look at live. We don't know how this is going to eventuate. You can see a similar thing happening. If we look on a higher time frame, such as, let's say, the 4 hour, what are we looking at here? We've got a key high. We've got price coming up to this level. It's then setting a swing failure pattern on the 4 hour, meaning you have a key high that's got liquidity above it in the form of buy stops. So there's buy stops there. Price moves up, sweeps through them, closes back below. So that's a potential reversal on the 4 hour. You then go to your 1 hour, take a look and see, okay, the 4 hours signaling to me that we might have a top, it might be reversing. So I'm going to look for the structure. The low which led to that sweep is this one. This low led to that high. And I'm doing this because I want to show you one live. I don't know how this is going to eventuate. And obviously, you can look at the dates, 29th of July. So whenever you watched it, 29th of July, 2022, after you've watched this video, go back and see how did it turn out. Because it's easy to say stuff in hindsight. And I'm not telling you that this is absolutely going to go down, but I am actively in a short as we speak on this, as are the students in HU. There's no after timing from this. Of course, this lesson will be watched by people in the future. But to me, on the 1 hour time frame, so within this, not only did we sweep this high, but within it, we've also got another setup. So we're getting a double confluence. On the 1 hour, we've got this high, as well as the main high, which gets swept. And we have shoulder, head, break down below, convincingly, close, multiple hour candles below this market structure level. We broke back above it, and we're now retesting this level, and we've got the level above, and we will look on lower time frames for the same pattern again. So obviously this isn't confirmed yet, but I would expect that eventually this chart also breaks down. And where are you targeting? You're targeting there. So I will go to the 15 next. What are we looking for here? Well, we're looking for the same thing before. We're looking for an over-under to basically create this shoulder. Do we have it here yet? No, not yet on the low time frame. Obviously on the high time frame, we could be making it because it doesn't have to create that pattern again. If you look here, the shoulder has formed, the head has formed, we've broken structure. So this could just drop now. The perfect way would be for it to see this low. Perfect way would be for it to run that, break that, retest. You can see that? Or this would be the market structure because we make a new high, we then break it and sell off. That's perfect. But what happens if it just goes like that and it just sells off? Wasn't it still a profitable trade? Didn't it still win? Yes. You're trying to get an entry on this right shoulder. We can go lower again. 5 minutes. Do we have any breaks? Okay, so where's the low that led to the highest high? This is getting a little bit tricky here. And actually, this is one where I can show you on the 1 minute. But this is the low. And this is what you should be doing all the time. You should be analyzing across these multiple time frames because you execute on the lowest time frame possible. So you can see that the high, you can see we did run it. All that matters is running. It doesn't matter if it's $1 because the stops are above it. That was the low. This was the high. If price then comes down, like it looks like it might even when recording this, if it breaks down to here, closes below it, bounces up and retests, that's a completed over-under. Let's go to the 1 minute and get a bit more granular with it. It's the same low. See, it was all green candles up to here. So we're still looking at the same low. So then on the 1 minute, you can watch. Do we break down through here? If we do, and we bounce back up and we retest and fall off, then you can say when it starts to get into this area and it fails to hold back above the market structure level again, somewhere like here, you can look at entering your short and you can call this the high if you're looking for a quick scalp. Or if you want to enter a swing trade, let's go back to the 5 minute. But our entry would be after the break, which is happening now as we speak. Then when it breaks back down like that, let's say, for example, it goes like this, that, just keeping this basic. What am I going to do? I'm going to try and get short on the retest of the market structure level line. If I'm swing trading it for lower, I would put my stop above the main head of the move, and I would be targeting a lower level. I'll be targeting this one, which would give you a 3.6 hour trade. So this is the low that everyone's stops will be below for all of this move. But that will probably take, again, like the previous example, that will probably take from here a day to play out, or 2 days. Imagine something like that, because a lot of price action has to develop. It's going to go down, it's going to go up, it's going to go sideways, eventually go up. If you're looking to scalp, a quick scalp, you go in lower, you've got your break happening, calling this the top. This is your obvious bottom. This is where your liquidity is going to be resting. You've got your liquidity target. Visualize the sell stops for you, which are sitting there. And then we look at risk to reward. Can we get a trade on? Okay, short, the retest of this line. Or what you could wait for is, you could wait for a retest and a close outside it. So you want to see a 5-minute candle retest this level and then close outside it. That's your trigger to enter. So let's say you get entered somewhere like here, your stop loss above this high, your target down here. That gets you a 2.4 hour trade, positive risk to reward above 2. That's something you could take. I don't know how this is going to turn out, but you can check in future. But that's 2 examples of over-unders, one that was confirmed and did play out, one that is in progress of playing out and meets all the same principles. A big breakdown, clearly breaking market structure, bouncing back up to make almost a perfect shoulder, if that's how it eventuates, and then we see. Okay, now we're going to look at chart patterns as an overview. As I said, the most important is, in my opinion, the over-under and under-over. Also can be called head and shoulders, inverse head and shoulders on this. I prefer the over-under and under-over because they actually constitute a market structure break as well. If you notice on this head and shoulders, the low that leads to the highest high doesn't get broken. So to me, I don't like entering those. I like it to break because that shows weakness in the market. That shows that sellers are in control. Then when it bounces, short that, goes down. Let's look at some of these patterns and I'll tell you what I think of them. Double top. Okay, it's just not my style of trading and I've been profitable without doing it, and I don't know many profitable traders who trade this way. Okay, and this is why I don't like it. A lot of these rely on breakdown trading. So if you look, the example here is that you have a double top, a high, a low, a high of equal measure. You then wait for it to break below the neckline. So you wait for it to break down here. You enter there, which you're essentially entering a short as it drops. And you're targeting down here some arbitrary number. And you're putting your stop loss halfway up the downward. It's fucking idiotic, to be honest. Because what's actually going to be more likely to happen is this. Yeah, let me go to a chart and visualize this for you. Because it's fucking idiotic. So this double top bullshit, you got double top. And what they say is, you basically do this. You wait for this to break. You then enter a short. You enter a short on a breakdown. So you enter a short from here to here. You enter a short from there to there. And you put your stop fucking randomly just there. What's actually more likely to happen is this. When it breaks here, what has it done? It has swept some stop losses of longs. So that's some guaranteed liquidity. Imagine you went short here. Where would you close it? Here, at liquidity. So you close it there. What's going to happen when you close it? That's buying. It's going to bounce it. Where's it going to bounce to? It's going to fucking bounce to there and then go lower. You see that? I'll do it again, just with no entries or exits. What they're telling you in the retail book that a million other people have watched is this. Short that breakdown. What's more likely to, and put your stop here. What's more likely to happen is this. High, low, double top, yeah. Breaks down, doesn't go to your target, bounces to there. That's literally a perfect downtrend. That's exactly how it will go. You've got your double top, you've got a low, a high, a lower low, a lower high. That's a downtrend. I don't know what this, I don't know. You know what? It's a good thing because anyone watching this is going to make a lot of money off dumb retail. So let them keep doing their stupid patterns. So anyway, back to the stupid patterns. Now, I'm not saying that a double top isn't something that happens quite often in markets. But for me, a double top is something I want to target with a long. We only have to jump back into the chart to see some, maybe if we go to 4 hour, it'll be a bit more. And obviously higher time frame takes precedence, so 4 hours a bit better for this. Maybe double bottoms are better to look for in the bear market. Let's look at this double bottom here. Double bottom, because we've been downtrending, so it's going to be more of those. But double bottom, so here, and then the retest. Pretty standard double bottom. Don't get autistic about it not being exactly to the, these wicks. Again, think of it in more of a range. We had 2 taps in this little area. That is a double bottom, all right? Don't overthink it. Sets that. Okay, so people go long. It does get a little bit of a bounce, but it just bounces up to range high. How would I be looking at that? I wouldn't not long it. If I got a setup anywhere in here and it was signaling to me to go long, I would still go long. But in the back of my mind, I would always have my higher preference is to short down into this, because this doesn't hold. When these get set, they typically don't hold. Whenever you're up here and you're getting signals, or you're thinking you're going short, think this rally's not going to last, you can target this level. All right, so targeting a double bottom, targeting a double top is what you should be doing, in my opinion. You're guaranteed your take profit for your short will be at the bottom of a double bottom. Your take profit for your long will be at the top of a double top. You hear me talk about it all the time, and it's a very common thing about sweeping the highs, sweeping the lows, because that's where liquidity is. Price is going to go through those levels. You can see this one here swept by just a couple of dollars, but it still swept this high before a big sell-off. Why do you think there was such a big sell-off from here? Because it went above an area of key liquidity. Again, it doesn't matter if it's $1 million above or $1 above. It's not going to be $1 million above. It gets over there, it takes all the liquidity that whales and whoever else wanted to grab, and then there's no reason for anyone to buy anymore. It sells right off, right the way down to there. All right, so why I'm not a fan of just a double top itself or double bottom itself. As a reversal pattern, no, don't like them as reversal patterns. Head and shoulders, we've been over that. Head and shoulders is okay in theory, but over-under is better. Rising wedge, not something I pay much attention to or really trade. Rising wedge states that as it goes up in a compressive pattern, it's more likely to drop down. In my opinion, a lot of these as well, a lot of these old TA techniques are from stocks and Forex and things. We're trading crypto. Crypto is not the same. A chart is a chart, yes, but crypto does act differently. It's actually quite common in a rising wedge for price to break upwards in crypto because this indicates a short squeeze. It doesn't typically end with no spike above. It doesn't typically just go up like this and then fall off. In a perfect world it would, but crypto's full of over-leveraged traders, so it's more likely that they get blown out than actually breaking down nicely and everyone having an easy short. I'll show you one example because it happened actually recently. Go back to the current level that we're at. It's actually more visible on ETH. So let's go to ETH and let's look at this. Look at this. Isn't this a lovely rising wedge? All right, let's go back here. Rising wedge, it's going up and compressing. It's basically the rising wedge. Now this isn't going to look perfect, but it is going up and it is compressing. And it's going up and it's compressing. Again, nothing's perfect, but you can see pretty clearly it's going up and it's coiling up, yeah? So the TA guru with his textbook would have told you to short that. What happens in crypto? It blows you out. Because these are, to me, this is just a typical short squeeze. This is pushing up, pushing up, pushing up, squeezing, squeezing, squeezing. Shorts are getting squeezed. It's pretty common sense. If you're ever in doubt about these things, practice your pattern recognition. Go back through the charts. If you go through the charts, look for examples like this and see what way do they more typically break in crypto. Look at these lovely examples here. Here's another one. Rising up, compressing into a pattern. A quick fake out below, pumps. Wrecks everyone. So these rising wedges that everyone tells you just automatically drop off, they don't typically. There are a couple that are very reliable in crypto, and we'll get to those, but the rising wedge is not one. Double bottom, been over it. Inverse head and shoulders, again, under over is the way you should view it. Focus on the market structure break, don't focus on the head and shoulders. Falling wedge, again, not a fan. That's basically 4 lows that need to get swept. So a falling wedge in crypto, I don't even think you see them much. Let's go to a bit of a higher time frame. Let's go back to Bitcoin because Bitcoin's a bit more clean. Do we have a falling wedge? This was one, and this is a super nice example. From here, trying to make it as close as possible. You've got your lows here, so kind of like this. So that you can see is pretty clearly a wedge. Yeah, so it's going like this, it's compressing. And so, how does a falling wedge, per the gurus, tell you it's going to go? Falling wedge. Oh, put your stop down there and target some random level above. Okay, well, let's do it. So we will go long here, obviously, because it's, look, third tap on the falling wedge. This is going to pump. So let's get in here, wherever. Put our stop, below the low, below the wedge, outside the wedge, because it can't go outside the imaginary line, of course. And then we're targeting random area up here, whatever. How does it go? Starts off with a fake out pump, wrecks them, and then actually does go higher. So this is where I want to talk a little bit about how these patterns do have some validity to them. A falling wedge, and you need to think about what does the pattern mean. Price action, it's never random. There's always some meaning to it, right? There's always something that it's telling you. If price is going down, getting lower and lower volatility, so it's compressing, That's telling you that there is weakening strength in the downtrend. Because how does a strong downtrend go? It goes like this. Down, down, down. How does a downtrend weaken? It goes down, down less, down less, down less, and eventually goes up. Yeah, that's how trends weaken. If it's going like that, that's it. No, that's not stopping yet. That's going to have to take another small leg. Oh, then all right, okay. Now we're starting to bottom. Understand? So that's what the wedge is telling you. It is telling you the downtrend's weakening. Otherwise, if it wasn't weakening, price would be breaking more. So what way would you interpret this? You would say, okay, if this pattern fails, in air quotes, which it did here, where it breaks down, that's when I'm going to look for a long, because the chart pattern gurus were actually correct in that the downtrend was weakening, and they got wrecked because we know their stop was down here. So the market was signaling, but it was not signaling for them to be retarded. It was signaling, yeah, we are weakening. But remember, it's crypto. Everyone screams manipulation. I love manipulation. We got some nice manipulation here. Push down, wreck them, get long in here, ride it back up. That's a decent way to look at it, something like a wedge. And what does that do? That puts you on the minority, not the majority. You've got all the dumb retail who are getting wrecked because they just thought that fucking lines on a chart could mean where price is going. And you make bank. Next, falling wedge. And the other side, same again. Bullish rectangle. All right, so a bullish rectangle is essentially a bull flag. The rectangle can go two ways. It can go like this. A rectangle can go perfectly sideways, then up, or it can go like this, which is more common. Go up, and it can go down in a perfect rectangle, and then go up. All right, you see that? You still see that the lines are straight, indicating it's a rectangle. It can do it on a downtrend, which is a more typical, this is what you would call a bull flag, where the lines are still parallel to each other, and it goes up. All right. I don't have a very strong opinion on bull flags, because to be honest, I don't see them often in crypto. Because crypto doesn't tend to move in nice, tight, parallel channels. So it's not something I'm going to really talk too much about. What I will say is, if you see one, same as here. If you see one, look for it to break down. Look for some absorption, so the price still, it's failing to go lower. It starts to come up a bit. We break marks. Like around here, you should be all systems go for a long. Because you've had this nice move that broke down. Price is clearly making some type of attempt to reaccumulate, and we blow them out. Looking at the flags, I don't see them that often. I wouldn't really focus too much on them. The next one, the bullish pennant and the bearish pennant, they are super, super common in crypto and are something that I actually do believe has some validity. So as continuation patterns, bullish and especially bearish pennants are pretty good, and especially on low time frames. So let me go to a 5-minute chart and show you some. The first thing you have to do is wait for a big move. Here's one from today. There's a perfect one. We've got a move down. We got a bounce here where we had this low and this one into a nice pennant formation. We had these highs here into a nice pennant formation, and it broke down. Now, of course, this is a 5-minute chart, so the breakdown has to be commensurate to the move. So this break is all you can really expect. But if you understand that this pennant is likely to break down, you could have got short somewhere in here, try and get as high into it as you can. After it's starting to really look like it's under pressure. You could have even caught this part, but let's imagine you try and get short somewhere there. You get your stop above there, and you target just the new low, right? Just the new low, not all of this below. You get a 2R. I'm not saying you should do that every time, because it's a very small move. Look, it's only $75 of a stop. That's easy to get hunted. But especially in crypto, whenever price is selling off, especially when it's selling off, these can be reliable. Looking at that, see if I find some more examples of them. This is one, I guess you could say, on the upside. If you kind of squint, you can say, okay, this, and then this, a little bit better. That's roughly a pennant, and it does continue. The reason that happens is because when you have a big move in one direction, what you want to see is support for that move, whether it's up or down. If you have a big move and price starts to go like this, that means that there was enough liquidity to hold it up. You could say, yeah, there's enough selling to hold it down as well, but we just had a big move. The big move means something, and it's more likely that that will at least go up or at least have a sweep or something. It should bounce first. If it was actually bearish in this instance, what it would do when it comes up is it would fail to hold that level. It would drop a lot more and then bounce. This is not bullish. You see the subtle difference in this. If you have an early strong drop off, I don't have any specific number. Some would say maybe past the 50%. So if you got your fib too, you went from the bottom of your pump to the top of your pump. And if it drops back below the 50 and bounces, that's a pretty good metric to use if you want. If it drops back below the 50 and then bounces up only to like a 75 mark or 25 on this, you can look at that and say, all right, this is actually a bit of a blow off top, a weakening, and it's probably this move would typically peter out into a drop. Contrast this with the other one, which I've just deleted like an idiot, which is exactly what this move was. If you look here, bottom of the pump to the top of the pump, it barely went past the quarter point, nowhere near the midpoint, nice little pump after. Same as here. Bottom of the pump to the top of the pump, down to the 25, nowhere near the 50. That should continue. That's a decent one. I always like to do these on the downside rather than the upside because crypto trading is retail heavy. There's a lot of retail who trade crypto. Also, crypto, because of the nature of it, it's not like gold, it's not like wheat or corn or oil or these things you can trade where people just trade them to trade them. Crypto also has the cult aspect where people really want their coins to go up because they want to be a millionaire for doing nothing. So inherently that creates a bias in the market to always want to be long. So I don't like bullish patterns as much as I like bearish ones. A bullish pennant does not mean as much to me as a bearish pennant does. I prefer bearish pennants, okay? I think it's obvious why. They're more reliable because it's hilarious. When price goes like this, you go on Twitter, bullish pennant, we're pumping. You go like this on Twitter, no one says anything. Or they try and make it into, it's accumulations. They're coping. Whereas you're filling your shorts, nice another leg down. Same with an over-under and an under-over. You can see this one develop that I talked about earlier in the lesson. And you can see how it's developing a little bit better now because people just see what they want to see in crypto, which is bull only, no bearishness. We had big grab above liquidity of multiple time frames. It grabbed above this high from days ago, broke back below, 4-hour swing failure pattern, clear break in structure down to here. And what does everyone say? Reaccumulation, we're going to pump. No, what we're doing is forming a pretty clear over-under. Again, look back in this in future. I think this is going to break down and at least make a new low below here. Come troll me in the chats if it doesn't. I think it will. Maybe it doesn't. They're not 100%. But you have multiple confluence factors here. One, crypto apes are long biased. So they haven't longed this because they thought it was going to zero. They've longed this big green candle. So they're long here. Whereas you can see it's actually distribution. You've added to your short or filled a short. You're just going to freewheel off their liquidations. That's probably enough chat about patterns. Ascending triangle, descending triangle, they're pretty decent. They don't go like this in crypto. Symmetrical triangle, just a pennant. What's the difference? I guess it's trying to... I don't actually even know. So fuck that. All right, bilateral. So what they're meaning by this is, depending on what way it breaks, you trade that direction. That is complete horseshit. Again, this is encouraging you to break out trade. Because it's saying, if it goes into an ascending triangle and it breaks out, you should go long and you should target there. Okay, great. But what are you doing then? You're buying on the way up. Fundamentally, it just doesn't agree with my system. If you want to do it and you make money, fine. But in crypto, that typically gets invalidated. And look at this as well. These ascending and descending triangles, they do have some validity, but look at what they are. Let's go back to the chart. You make all these fancy names for things. What is an ascending triangle? It is literally a horizontal resistance getting tested multiple times. You see that? What happens the more times you tap resistance? It's more likely to go through. So there's no mystical powers to it. It's just horizontal resistance. So forget about the pattern. Just look at, where's my key support, key resistance? So go to a higher time frame and say, all right, where's my key support, key resistance? Well, my key support is, there was one back here, where do we have it? Maybe it was on ETH. Here, decent example here. And this one did eventuate in an uptrend. If you were busy looking for a ascending triangle, is that what they call it? Yeah. If you were busy looking for an ascending triangle here, when you had this nice, see this high that led to a break? This high, tested, and tested. 4 taps of this lovely level. And you were like, okay, well, what I need to see now is this pattern, where it goes like this, but it didn't go like that. It went here, it made another flat low. It's not exactly an ascending triangle. I can't long that. Like, why? That's dumb. What you want to look at is resistance, getting tapped multiple times. It obviously sets it here, so that doesn't count, but tap, tap, tap. 3 taps. Again, don't be autistic. It did tap again. We're touching up against the same area. This is again why you should use areas, zones. You do it like that. Look, wow, get rid of the line, then you can see it. And so then you can say, all right, 1, 2, 3, 4. I'm going to look for a low time entry, but the chances breaking are super high. Breaks, obviously, yeah. So that gives you a nice framing and way to view your trades. And I don't care about the symmetrical triangle. It doesn't mean anything to me. So So that's like an overview of some retail chart patterns. You'll notice I didn't just shit on them all. I do think some have validity, particularly bearish pennants. But also you can see pretty clearly that trading just blindly, trading a bull flag, bear flag, pennants, whatever, it's not going to get you anywhere. But you can use them in confluence with other factors, and you can trade them certainly pretty well. The number one chart pattern is an over-under and under-over, as I mentioned at the start. But other ones have their uses. So tonight we've covered my views just as an overall on chart patterns. We went through the over-under and the under-over, and we've looked through like the common chart patterns and what they mean and how I look at them. And I want to show an example of me actually trading a breakdown of a bullish pennant, which led to a pump, and you can see in pretty clear detail the best way to trade against retail in the markets. In the example, I call it a bull flag. It's actually a bullish pennant. It's a small thing, but it's important to know. Flag should be rectangular, pennant is like a pennant, it's a triangle type shape. So look at that, we'll cut to it now. Right, so you got a typical bull flag. Let's say it's like that, or whatever pattern you call it, pennant or continuation. Price comes up, consolidates in this pattern, and then breaks down. The way retail will trade that is one of two things. They'll either short the breakdown, or they'll short the retest, short here as it retests. They won't typically wait for it to actually fail, or even if it does, they'll typically short the breakdown. They're the type of people we're trying to trade against anyway. People who wait for more confirmation are not really the people that you're trying to beat, because they're typically a bit better. You're trying to beat the really bad traders who short the breakdown. What I want to look for in this is that same pattern where it breaks down, but when it breaks down, I want to see signs of reaccumulation. So when you get this pattern, what you're going to have when it breaks down is you've got stops resting here and stops resting here. So as it breaks down, you're actually sweeping long liquidity, and it sells stops, long as getting stopped out or liquidated. So there's a good chance that if you can then see some kind of reaccumulation down here, that it's actually going to be a fake out and go higher. And also then, this isn't maybe drawn perfectly for that, but let's say this reaccumulation happens and then it comes back up. You'll also get the trend line traders who short the retest of the bull flag or whatever pattern it was. They'll short here, which will add fuel to the eventual break higher. Patterns in this sense are valid for me because, of course, you have the typical pattern that everyone knows of, and they expect that to just break out nice and cleanly higher because it's meant to be, these flag formations are meant to be a continuation pattern. That's not how I like to trade them. I like to trade the failure of them. The failure of it is not the fact that it broke down, okay, because you have to remember that this is sort of like an extra level of thinking beyond it. You've got kind of first order and maybe some second order thinking in here where you've got trader one, okay, so the most basic retail trader will see this and they'll go long because they think it's a flag and it's going to break higher. Trader two, who's thinking a bit more deeply about it, thinks, okay, well, this is a flag, it's going to be a fake out. Retail retard is going to go long, therefore I'm going to go short. And then it breaks down, so retail or trader number two thinks that they're right in their thesis, but then in reality, what's happening is it's actually, trader number three who says, I'm going to let all this form. I'm going to let the long get wrecked, let the bear, let the short get into his position, and then I'm going to jump in whenever we reaccumulate here and blast everyone out. So that's sort of how I want to trade them. I want to be number three on that list. I want to let things play out. It meets a lot of criteria that I have for trades. The number one being patience. So the fact that you've let all that play out in front of you puts you in the better position. You can see the full chessboard, you can see all the moves, and you can then react accordingly. The person who longed the flag has jumped in completely impatiently, and the person who shorted the breakdown is, they've waited for an invalidation of the flag, but they didn't wait for a confirmation of that. So they still are impatient. Just because the flag breaks down doesn't mean it's automatically a short. It would have to come back up and bearishly retest to then confirm that it's a short. Playing this along here, I want to show where it actually formed today and the trade I took live. So here we have the beginnings of the flag that we're going to be trading, and I'll slow this down a bit. You can see here now that price comes up and begins to form a flag. So from previous teachings of mine that when price goes up and into a pennant or a flag, whatever formation you want to call it, these are typically continuation patterns, because if price moves up and then it consolidates, it's typically consolidating to move up again. Similarly, that when it breaks down and it consolidates like that in a compression, it's going to continue. It's typically a continuation pattern. So we can see now that this flag is formed in the eyes of retail traders. The way that the average day trader would be kind of marking this out is like that. Okay, so we had the top end of the flag, we have the bottom end, we have a couple of taps of it. And so for a start, most would have been going long here if they're long biased and believe the pattern is going to play out. They're going to have gone long there and obviously got wrecked almost immediately. They've probably gone long there with their stop here, so that low becomes a target very quickly. And then anyone who's shorting now has seen this break from here, and they're probably going short here. So you're getting a lot of selling because you're going to get the longs getting stopped out along with the breakdown shorters. So you should expect this move to push down a little further just from the amount of sells that are coming in. As we play it on, you can see that it kind of consolidates briefly, but it does eventually break down. So now at this point, we've broken down here and we've swept out this low. So this was the main target really, in my opinion. So when the pattern is broken, I've got everything I want to see now. So we've got sell stops here where my red line is. We possibly have some sell stops here as well. The bottom end of the flag, the initial low, where there would be more stops, I will put that as my invalidation for my thesis, which is in this pattern, I want to get long because I've seen a breakdown. So we know that anyone who longed the actual flag, they've been stopped out because it swept them out. I want to get long here because there's breakdown shorters and I want to absorb them and push them the other way. If it goes below this low, I would invalidate that trade. So if we happen to nuke down into here and take out the yellow low, I would just consider it to be an actual reversal because at that point we would be like here and price would then just look more like it's reverting back to this consolidation and it's probably going to sit there for a while. So that's an important thing, so that when the flag is created, whatever you want to call it, the top of the pole to the bottom of the flag or whatever, basically the initial drop, the low of that shouldn't break for this structure to remain valid. What am I looking for then? Well, we swept out a low, so technically we've now done enough for me to get in a long. As in, we've swept enough liquidity for me to get long and target the highs here and the highs here, because they're going to be my targets. The purpose of this video isn't to recap this trade exactly. It's more about the pattern. But if you zoom out, which you always should have done from the start, the main reason I was long biased here to begin with was because we have a lot of liquidity here. You can see these equal highs, highs here, highs here. That's my ultimate target. You have those highs, they should get swept. There's confluence. I'm adding more confluence. The reason why I'm long biased is because we came all the way up to this key level of liquidity and didn't tag it. So this is a really perfect setup. You don't get these too often, which is why it makes such a good example. Well, when I say you don't get them too often, you get them a lot on the 1 minute chart like this is. It's just very hard to be able to spot them and execute them consistently over time without, fucking something up. Because when these form on a 15-minute or a 1 hour or a 4 hour, they play out much cleaner and you have more time to react and make your decisions and everything like that. But when they play out like this, in a 1 minute chart, it is, it's in the heat of the moment, but that's the nature of scalping. So anyway, currently now as we're developing this, I can see this high as being my key level. So that I play under overs and over unders, that head and shoulders type pattern. Okay, that's how I trade my entries. You have the clear signs of the accumulation. Here would be my high. I would consider this led to the lowest low. So let's let it play on and see how it develops. So I wouldn't be in a long yet. I'm not in a long yet. I don't know if the trigger. We've swept the liquidity, but we haven't confirmed that the bottom is in on a 1 minute. And now we've got flat lows. So there we go. Now we've swept the second lows. So even more confident now in the long trade if we can get the setup that I'm looking for. But we've swept out a lot of liquidity in this small time frame. And as I pause again, we've now broken back above this first line. So when we come down here, we swept it out here initially. We pushed away and we swept again. Now we've broken back above the initial line of where I think the true target was. It's not enough to get in along yet, because as you can see, this now becomes my high, because in my chart, these blue candles are up candles and the white ones are down. So the last up candle before the lowest low, so this was the lowest low, all these down candles. So this was the high that led to it. So for market structure to break bullishly, we have to go back above that and close through it. And when I'm scalping these on a 1 minute basis, I typically want to see a 5 minute candle close above here. Then that would trigger me to go long, and I would long any retest back below the line, right down to the original low that got swept, which you could say is this one or possibly that one. Essentially, I'm just trying to get longs filled here. So we'll play it on. So no structure break yet. All right, there we go. So we do have a structure break here. You can see price comes back down beneath it in real life and in the thread. I put half my trade on there. If you go back and look through it, you can see where I put it on. I entered half there because even though it didn't close like a 5 minute candle above, and it actually sort of pushed up and then dropped down, what I'm kind of seeing here is price looking to go higher much more than it's looking to go lower. So you can see a lot of upper wicks. That indicates the price is getting pushed lower, but the more times it comes back up, then it indicates that there's absorption down here and we're actually trying to go higher. You see it pushing, pushing, pushing. That would indicate to me that we're squeezing on shorts. So I entered half there. Now the other half would be as soon as we close back above this line. All right, I would be willing to enter my second half. Okay, so right there, let me just see. there. Okay, so whichever one, if you wanted to do it on this one here, because it did close through, or on this one, regardless, I'd be entering my other half there, and it did enter my other half there, because if you're going to reject from these areas, you shouldn't be consolidating up here. The way this is consolidating basically is consolidation that's going to break higher. You can see that pretty clearly. We're moving up and it's consolidating and setting up flat high and pushing and pushing and pushing, and eventually that'll break. That's my plan. That's my trade, sorry. So I entered half, whatever it was. Like basically, let's say it was on this line. Stop below the low, because remember on this sweep, we're now confirming that this breakdown was an absorption of all the sellers here. So both the forced sellers and the willing sellers, so the stopped out traders and the breakdown shorters, they've been absorbed here. We've shown low time frame signs of reaccumulation. So now we should break up and break up pretty quick. You would have target 1 is here maybe at 2 hour, target 2 at this high, but really my target 2 would just be here, because this high is so close to that high. I know this is the main target. It's not going to come all the way up here and sweep this one out without sweeping that one. So it's a 3-hour trade. If you wanted to take some off at this high, you could. That's up to you. I'm not really here to talk about trade execution on this one. I'm talking more about flag patterns playing out and how I like to counter trade it, essentially. Be in that third category of person. You're the guy who's just camping up. You're the guy sitting, waiting patiently, like a sniper, letting everyone else make their decisions, make their own decisions, and then you're coming in and taking your little scalp off them. I'll let it play on for now. Alright, so we get some more consolidation. We break higher, eventually breaking out of it. So now, obviously at this stage, it's a very strong signal that we're going higher. The next area to look at would be the retest of this trend line. So I'm going to get rid of this one, because now it doesn't really matter if it's a flag or not, because obviously the flag's been invalidated in the eyes of retail traders. What they will be looking at now is this trend line. Okay, so the trend up, trend up, trend up, and we broke that. So the retest of that, typically the people who've been wrong here and wrong here, they're about to be wrong again, because they're going to try and short this. They're going to try and short the breakdown of this trend line, because they think, well, this is a breakdown and it's going to fail here and go lower. But what they haven't noticed is they're probably not a good price action trader who's looking for reaccumulation, and they haven't noticed that we've swept out liquidity and reversed. So we should be going to sweep liquidity above. There you can see right away, we've tapped off that line, so I'm not sure if it closes back below it again. No, it just continues right on. And obviously this trade was very quickly executed and almost before it started. So in 3 minutes of impulse, the entire trade was hit. So you can see in the group, I took my profit at 57.5, and I took the second bit actually slightly below the white line. So my average is still around the white line, because I wanted to see was it going to be continuation, and there wasn't. It was just a straight stop run. You know, so if we play it on, you can see. So I took half, I had half sitting and was taken out there, and then I took the other half. After this bit, the next up move around there, I think it was maybe that green line, was where I actually took profit. So, and as we play it on to, to now, you can see what happens thereafter. So come all the way down and sweep out that low. So this is like, I'll delete all this off. In summary, it's a good example of a scalp, okay, playing the chart pattern in a contrarian way, so letting everyone else make the wrong decision with the chart pattern. And if you look at it here, actually, there was probably even a moment before, like this and this. You have to remember that these people who trade chart patterns like that, like retail, they're trying to confirm their bias. So they want this to be a flag so they can go long. So they'll be drawing every line they can to see this and that and this, and they go, oh, all right, oh, look, we're breaking out, flag, and they'll have gone long here, and then that will have reversed. So what do? They move their lines, of course, and turn this into the flag. So you can see we're actually very cleanly, they got wrecked here. So there's one area got wrecked, so we went long, got wrecked, comes back inside. They're like, okay, well, I was wrong with that breakout, but I'm going to go long here because we're going to confirm and go higher. They got wrecked again. Then the breakdown shorted it because it failed, in air quotes. And then we had reaccumulation and they got wrecked again, got squeezed super hard. And not only that, this is a good example just before I finish. This is a good example of the warning signs of sitting in a scalp for too long. So it's easy to sit and admire your work because you caught this great entry and you spotted this reaccumulation. If you didn't take profit off at the target, you then got wrecked within a couple of minutes and right back down to where your stops would have been. So this is my exact level that I marked where my stops were. And you'd see if I had sat in that trade too long, I'd have got stopped out. So we'd probably go higher now, just based off that. We'd probably bounce back up into this area or something. Don't know if it takes out either side. That's probably the move. Typically when you get these high volatile moves, that's it for quite a few hours. That's a good little aside to the main point of don't sit in your trade too long. have your targets. If this flag breaks down and reaccumulates, your targets are very clearly here, and then the one I showed you earlier, the main high. Get out on those. You're scalping. You're getting in and out. You're not here to take 10,000 points out of the market or big swings. You're scalping in and out. And if you had done that, you could have watched all this unfold and maybe even caught a quick long down here and took those other people's stops and maybe ride them back up into this gap. Okay, final thing I'm going to include in the chart pattern section are trend lines, because trend lines are super popular in crypto because, again, it gives this kind of mystical feel to the market where people are like, yeah, this line means the price is going to do something significant. So there are valid use cases for them. Let me show you what is not a valid use case. What is not a valid use case for trend lines is doing this. So you can see here, this, and this. What does that mean? If anything, this lost you money, right? Again, which is not surprising because these are retail dominated. But you draw a trend line across the top and the lower high. Price comes up and it taps it perfectly. Oh my God, yes. Trend line valid. Short into it, get blown out. There you go. I could end the trend line lesson here. They're horseshit if they're used like that. A good use of trend lines is for visualizing a weakening trend. So there was a good example. Ethereum Classic has done a few nice ones in the recent past. Let's take a look. This one here is lovely. So you go to a lower time frame, go to the 4 hour, look back here, you watch, because how price moves in an uptrend for crypto, very typical of a squeeze, is it'll go up like this and it'll keep squeezing and squeezing and squeezing, just in this kind of nice higher highs and higher lows uptrend. When that gets broken, you want to start looking for more distribution and go short. Super visible here. You use this trend line, and even from a trend line perspective, it even acts as it should as a normie trend line. But what it's visualizing, the reason I like this over others is that I'm not just entering because it touches a fucking line I drew on the chart. The reason I'm entering is because this break, which also you'll notice has multiple market structure breaks, which are more important, but I'm talking about trend lines because I know you love them. It also breaks down and then retests and then sells off. There's a couple of reasons for this, and this type of analysis is actually more valuable on alts than it is on Bitcoin or Ethereum. The lower down you go on altcoins, this can actually be a little bit more accurate. So obviously, number one is always market structure. So if we're looking at that, the main market structure was here. So it was this low on a 4 hour. See, this low led to that, the highest high. So the breakdown of this mean trend line actually coincided with a break in market structure here. So you could say, fuck the trend line, market structure break, I'm going short, targeting new lows or whatever. Okay, yeah, that's one way of doing it. But what does this mean? What does this actually give you? It gives you confidence. This is what I say. People ask me, do you use trend lines? Do you use this, do that? Everything is useful in some sense. So we have a trend line and a market structure break. Great. 2 pieces of confidence. Then if we get an over-under here, if we went to lower time frames and we have an over-under, we'll load up the boat short then. You have 3 pieces of confluence. Very likely that we're going lower, and we obviously break that. So that's the way I would look at trend lines and try to use them. I don't just draw them across like a million lines on the chart and diagonals. Basically, diagonals are astrology for men because they're diagonal. Like there's no such thing as diagonal support or resistance. It does not exist. If something bounces off your nice trend line, that's just a coincidence. Or, and this can be true in some sense, a big thing that people forget about the crypto markets versus other markets is that these, and this is the reason why I said it, not including Bitcoin, Ethereum, these coins have nothing, like no value mechanism, no worth, nothing. There's no earnings, there's no PE ratio, there's no things that are in the real world, revenue, profits, losses, there's none of that. So what are they actually based on? A lot of times the price of these coins are based on technicals. So that's where sometimes you can see on the lower alts where trend lines can look like they're getting respected, or at least showing the weakening trend, like I like to use them. But even for as far as, and it's a bit of a side note, but even for as far as things like RSI, moving averages in particular, moving averages can be quite useful, and there's going to be a lesson on them, so I'm not talking about it too much now. They can be quite useful for especially alts, because how do we value Ethereum Classic? It's only speculative traders buying and selling. So how do we value it? How do we know where we're going to trade, where we're going to exit, where we're going to enter? Well, sometimes they'll draw a trend line like this. They'll say, oh, it's broken the trend line, I'm going to go short. And obviously you don't want to be on the same side as the market all the time. But if all of the market agrees that we're going lower and they stop buying, we will go lower. You want to be contrarian, but also when the big moves come, it's because everyone's in agreement. Everyone says we're going short, or everyone says we're going lower. Okay, they stop buying, it forces price down. That's just a quick note on trend lines to put in at the end. But this lesson has covered chart patterns. The most important, over, under, over. And then kind of a look at the retail normie patterns. A decent example of how to trade a bullish pennant that broke down and got a nice pump, and then touching on trend lines at the end. And so that's everything for now. We'll go to the next lesson, lesson 5 after this, but I'm going to end it here.